Today, we're answering some of the top questions from Reddit, specifically those involving investing, saving, retirement planning, things like that. So let's get right to it. Should I prioritize building up savings or investing money in ETFs? Just looking for some advice. I recently hit a savings goal of mine and I was wondering if I should be focusing on building up that savings account further or I should be more focused on investing. The goal eventually is to put a deposit on a property, even though it's far off, 10 to 15 years. This is a great question because it brings up so many factors that you absolutely should be thinking about. Whoever wrote this, you should feel proud that you're already thinking through these things, right? You're already thinking about, hey, what's my time frame of buying a home? Should I be saving more? Should I be investing more? Not everyone goes through that, and I think you should feel really proud about that. So here's the answer. This is just general, right? Who knows this actual situation? You should first build up savings. The savings should be able to last you at least 3 to 6 months if you were to lose your job, something unexpected came, or you woke up one day and you said, I don't want to work for this company anymore, I want to go travel the world. You want at least 3 to 6 months worth of cash savings sitting in a cash savings account. Don't touch it, let it accrue some interest. Don't put any of that in the stock market. If you have any other short-term goals, maybe the next year or two, outside of your emergency fund, you may want to consider saving that in a cash account as well. I don't like the idea of putting that money in bonds or anything but that restriction-free bank account, so just keep that in mind. You also want to have enough cash in your main checking account or main cash account that will last you at least a month, right? Whatever that amount is that you spend every single month, you want that balance in your bank account so that you can, automatically pay off your credit cards, things like that. From there, everything else probably should be invested, especially this property that you're thinking of buying in 10 to 15 years. Anything over that 3 to 5 year time frame out, I would absolutely suggest investing it, right? Investing is typically going to get you a long-term better return than letting your money sit in a savings account. The reason is that the stock market in the short term is very unpredictable. Some people only look at like a year, going back a couple years. Span out, go to Yahoo Finance and span out for like 30 years. What you'll see is there's a lot of dips, really sharp dips down, right? Every single decade, there's been a couple recessions or what seem like huge market crashes. But what happens? It always recovers, right? And we're talking about the global market or just the US market. We're not talking about like individual companies. Those are on that. So think about it from a long-term perspective and think, get your money working for you as soon as possible. So investing that money is probably where you want to do. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. How to even start investing. I want to start investing, but not sure which investing app or website should I start with, or when to buy, hold, and sell a stock. Can someone please give me some advice or a link from a helpful YouTube video? I got something for you. How should you even start investing? I think this question comes up a lot is like, I'm ready to invest, but what do I do? Where should I start? Which app should I use? What should I be buying? There's a lot of questions. If you like to do the research, that's great. There are apps specifically like Wealthfront that let you do the research and let you build your own portfolio, but also can build a portfolio for you just through a few clicks through a risk score. So I would say the first key here is don't let all of these questions hold you back from just choosing some form of getting your money invested in the global stock market. For most of us, it's buying a few ETFs that cover the US market, that cover foreign markets, maybe having a little exposure to things like muni bonds. Whatever your ideal portfolio looks like in your eyes, taking on enough risk that it's only meant for long-term purposes, get something going and start saving away now versus spending too much time thinking about it. This is a cool question. What was the most trendy no-brainer investment 30 years ago? So these days, the popular go-to advice is just buy VOO. Yeah, I hear that a lot. So what was the equivalent of that in the 1990s and 2000s respectively? What was the thing most educated investors recommended to people in general as the safest, most reliable, yet most potentially beneficial investment, the way they refer to VOO today? Did those things turn out to be the obvious no-brainer outcomes that everyone assumed they would be? I can tell you in the 90s, if you were to go back to then, the most trendy investment would have been .com, right? The most trendy investment were .com stocks. You don't need to do much research besides one Google search to tell you what happened to all the .com companies. Well, most of them crashed. The early 2000s, just a few years later, after many people were dumping their whole 401ks in there, they all crashed. So maybe this answer can just be about that. What was the most trendy investment? For a lot of people, it was putting all your life savings into a small section of the economy that was new and exciting and hot and young, and it pretty much failed. Now, there are certainly some companies that made their way through the dot-com bubble and are wildly successful now, right? I think if you were to look at the early 2000s, whenever Apple would have been a hot trendy investment, and that obviously worked out for a lot of people, right? But I think the key here is no matter what everyone says is the trendy type of investment, and yes, although VOO or just throw your money in a few ETFs is like the trendy investment, that doesn't necessarily mean it's the right investment for you. Think about whatever the right investment is for you. If it is putting your money in VOO and just buying that and putting your life savings in there, I'd take the chances that VOO is going to do pretty well. But I can tell you that I'd take the chances even more so putting my money in a diversified portfolio and not just investing in VOO, but I want some of my money invested across the global market. The US market has outperformed everyone the last few years, yes. I don't know if that necessarily continues long term. Long term, the US market is typically the best bet, but you want some of your money across the foreign markets, emerging markets, and some bonds for the years that it's not the best performer. Diversification is key here. Best place to park money if equities are tanking but inflation is increasing. Pretty straightforward, we are seeing SPY fall hard, but currently diesel is parabolic, indicating high inflation across all goods coming back with a vengeance after last month showed inflation easing. Where is the best place to put your money in this situation? No one has an answer. And if they tell you, here's the answer to this, I'm sure there's people in this Reddit thread that are saying this is guaranteed to be the right place to park your money during inflation. They're likely not going to be correct. Some of them might, others probably not. Long term, you look back at the history of the stock market and total investing, the best place to put your money during inflation, if it's meant for long-term purposes, is in a diversified portfolio. Whether that means buying a few ETFs, buying one ETF that's just the US market, investing in hundreds of stocks around the globe, anything diversified away from certain sectors, so it's not concentrated in certain sectors, but it's spreading your money out across the global market, is likely going to outperform a concentrated investment that could be hit a lot harder during inflation. Who knows when inflation will ramp down, right? It's mid-2022, who knows? No one actually really knows that. All I can tell you is that if you try to time the market or time the inflation market, for instance, you're likely not going to come out ahead. When do you anticipate pulling the trigger on dumping cash back into the stock market? I don't even need to read the full question to answer this one. So I think there's this methodology for some people that when the market's going down, they pull their cash out and then they wait for the market to hit its bottom and then they dump all their cash back in. So you might be successful at pulling your money out before it reaches the bottom. That you might be successful at. I'm not gonna argue that. What you're likely not going to be successful at is putting your money back in right before big surges. There's an exact study on Wealthfront's blog that we'll link below, but there's about 10 to 15 days that if you were to miss out on those, your return would be drastically different over the long term than if you were invested in those. Markets come back really quickly and all of a sudden, typically not when people are expecting it. So what I'd say is you gotta ride it all the way down, assuming that you're diversified. Ride the market all the way down. Don't pull your money out. Keep investing more. Keep your long-term strategy. You'll likely be better off than if you were to try to pull money out and then put it back in, because you're probably gonna put your cash back in too late. That's called market timing, and unfortunately, the majority of people who try it do not even match the performance of the index. I'm Tony from Wealthfront. Thanks so much for joining. Take care.